Hey everybody, this is Matt Thomas at tradingparadigm.com, and today I want to talk about the top 3 reasons why traders fail at such a high rate. The exact percentage of traders that fail is difficult, if not impossible, to calculate, but the general consensus is that 90% consistently lose money or break even at best. And some even argue that 90% is conservative, believing that the real figure could be as high as 95 to 99%. Unsurprisingly, this statistic often turns people off from giving trading a real shot, and some even try to use it as proof that day trading and other forms of active trading are scams. But trading itself is not a scam. In my experience, the real scam is the way most people approach it. I'm not saying that becoming a consistently profitable trader is easy, but the 90% failure statistic is deceiving because markets are full of untrained retail traders with no legitimate trading skills or proper understanding of what good trading truly entails. They're hobbyists or compulsive gamblers that just want the rewards, the money and profits, but aren't all that interested in the process involved to actually achieve it, the months and years of building new habits and skills. Financial markets are an environment with virtually no barriers to entry. Almost anybody can open up an account and start trading immediately. And in addition to that, there's the potential for generating massive wealth. So of course, this attracts hordes of people. But there's a gigantic difference between the mere act of trading and being a consistently profitable trader. Any random person can impulsively push buy and sell buttons, but it takes much more than that to be a consistently profitable trader. So to throw every market participant into the same bucket and say that over 90% fail, so it's not worth pursuing or it'll never work for you, is just wrong in my opinion. The failure rate between mere participants, those who are just there for thrills and excitement, and the failure rate for serious traders who are willing to study, practice, train, and build and refine new habits and skills on a consistent basis aren't anywhere near the same. So with that being said, let's dig right into the 3 primary reasons why traders fail. There's a fairly long list of common trader mistakes, but they pretty much all fall into one of these 3 main categories. First is the avoidance of personal change. People often have a lot to say in regard to their wants and desires, but there's not typically much action to back it up. To put it plainly, people are lazy. They want results without the work. It's just the law of least effort. But this is why things like guru alert services and chat rooms, where subscribers think they could blindly copy other people's trades for massive profits, are so popular. Because people try to use them to avoid personal change and development. But they're largely ineffective because personal change and development is exactly what's required to become a self-sufficient, consistently profitable trader. The fact is, it's extremely easy to want the money and lifestyle that trading can potentially afford, but it's not so easy to consistently perform the actual tasks required to achieve that result. Creating trade plans, journaling, meditating, tracking trades, reviewing your executions, and much more. Nobody can magically bestow new habits and skills upon you, so you have to take full responsibility for your own development. The second reason is a limited understanding of how markets work and what having an edge truly means. The internet is loaded with information on basic technical analysis and cookie-cutter patterns and setups, which people tend to think are magical answers to making millions in the markets. But a 5-year-old child can understand basic price patterns, like double tops and bottoms, for example. So there's obviously much more to it than that. Markets are dynamic, complex systems that require contextual analysis, nuance, and adaptation. So basic price patterns, without context, are virtually meaningless. What many people are missing is a deep understanding of market dynamics, structure, posture, and order flow. In order to see and interpret what's actually going on behind price movements and how price relates to value. If you're feeling confused by how markets move or aren't satisfied with the robustness of your current methodology, then I highly recommend checking out Auction Market Theory, along with the profiling and volume analytics tools often used in conjunction with it. Auction theory is a framework that removes quite a bit of mysticism from the markets for a lot of traders, almost like lifting a fog from your vision. What once seemed incredibly chaotic and random becomes substantially more orderly and structured. It provides a level of clarity and depth that most market participants don't even realize exists. The third reason is a shortage of reliable education and training. There are some great training courses and programs out there, don't get me wrong, but it's extremely difficult to find them in a sea of fake gurus and snake oil salesmen. And this directly ties into the first reason we talked about, the natural resistance to change. When blindly mirroring alerts, signals, and hot picks, instead of building the real habits and skills to be a legitimate trader, is what the masses want, of course there's going to be a bunch of salesmen and marketers creating products and services that feed on those desires for instant riches with little to no effort. These products and services aren't all that effective, but they sell really well. And as a result, we have a trading education industry full of useless information, ineffective shortcuts, and entertainment drowning out the legitimate education and training. Hard work and effort just isn't as easy to sell as get-rich-quick promises. And since real trading gurus aren't often interested in playing the game of creating advertisements showcasing mansions, boats, cars, and stacks of cash in order to attract people, their services often fly under the radar, or they don't even bother teaching or training to begin with. Overall, what most traders want, easy answers that don't require any personal or market depth, is not what they actually need to succeed: legitimate education and training. This makes great trading programs rare because, unfortunately, most people prefer lousy, ineffective alternatives. To wrap things up, I think the 90% failure rate is misleading because it takes into account a massive number of people who have no desire or intention of taking the right approach. The masses who obsess over the potential results instead of the process. But for those who actually focus on the right things, continuous education, training, and skill building, the failure rate is substantially lower. Like I said earlier, I'm not saying that becoming a consistently profitable trader is easy, but grouping every market participant into one giant calculation, regardless of commitment, skill, and experience level, is deceiving. There's no question that it skews the numbers. Although I have no real way to calculate it, I would venture to guess that around 75% of individuals who are passionate about trading and pursued it the right way would actually succeed. And for the roughly 25% that wouldn't, the main reason for failure would be not giving themselves enough time. Regardless of these hypothetical numbers, the bottom line is this: the vast majority of people approach trading the wrong way, and in doing so, virtually guarantee their own failure. But I firmly believe the numbers can be shifted around substantially for those who follow the right process. You can find the link to this full article down in the description, and I'll talk to you in the next video. Take care.